Something historic is happening in the financial markets right now, and most people don't fully understand it yet. Billions of dollars are pouring into Bitcoin ETFs, not from crypto traders, but from traditional Wall Street money, pension funds, wealth managers, hedge funds. Institutions that once avoided Bitcoin are now buying it through regulated ETFs. This isn't hype, this is structural demand. And when institutional money moves, markets don't behave the same way anymore. The real question isn't if Bitcoin changes, it's where smart money goes next once the ETF floodgates open. Now let's break this down in simple terms. A Bitcoin ETF, or exchange-traded fund, allows investors to gain exposure to Bitcoin without directly owning or managing crypto wallets. Instead of buying Bitcoin on an exchange, investors buy shares of an ETF that holds Bitcoin on their behalf. This matters because many institutions are restricted from holding crypto directly, but ETFs fit neatly into existing investment rules. Since approval in the U.S., Bitcoin ETFs have seen massive inflows, often hundreds of millions of dollars in a single day. This is not retail speculation. These are long-term allocations being added to portfolios alongside stocks, bonds, and gold. What makes this moment unique is who is buying. These aren't short-term traders chasing hype. These are investors who think in years, not weeks. And historically, when this kind of money enters a new asset class, it changes market dynamics permanently. This ETF wave is not just about Bitcoin's price today. It's about Bitcoin becoming a mainstream financial asset. And once that happens, smart money doesn't stop at just one asset. Who the smart money really is, institutional behavior explained. When people hear smart money, they often imagine secret hedge funds or insider trading. In reality, smart money simply means large, disciplined capital with long-term strategy. This includes pension funds, insurance companies, endowments and foundations, registered investment advisors, large asset managers. These institutions manage trillions of dollars. They don't chase memes. They allocate capital based on risk, regulation, liquidity, and long-term trends. Here's how institutional money typically behaves. Start small, a 1 to 3% allocation at first, wait for regulation clarity, scale exposure once volatility normalizes. Bitcoin ETFs check all three boxes. What's important to understand is that institutions don't buy emotionally, they rebalance. When Bitcoin enters portfolios, it often replaces part of gold, commodities, or growth assets. That's a huge shift. Another key behavior, institutions don't stop at the first opportunity. Historically, when a new asset proves itself, capital flows down the curve, from the safest exposure to slightly higher risk with higher potential return. Bitcoin ETFs are the gateway. Once institutions are comfortable with Bitcoin exposure, they begin asking the next question: what else benefits if Bitcoin becomes normalized? That question is where the next phase begins. What history tells us happens next? To understand what could happen next, we need to look at history, not opinions. When gold ETFs launched in the early 2000s, gold prices didn't just spike once. They entered a multi-year uptrend as institutions slowly increased allocations. After gold, money flowed into gold miners, precious metal ETFs, related commodities. The same pattern has happened with tech stocks after index funds, emerging markets after ETFs, bonds after fixed income funds. Bitcoin ETFs follow this same structure. First comes direct exposure, Bitcoin ETFs. Then comes supporting infrastructure, related assets with higher growth potential. Historically, once institutions validate an asset, they begin exploring adjacent opportunities, assets that benefit from the same trend but aren't yet fully priced in. That doesn't mean reckless speculation, it means calculated expansion. The key lesson from history is this: the biggest gains often happen after the asset becomes accepted, not before.
Bitcoin ETFs mark acceptance. What follows is positioning. Where smart money is likely looking next. Now let's talk about where smart money could move next, not predictions, but logical extensions. 1. Ethereum exposure. Ethereum is often viewed as the infrastructure layer of crypto. If Bitcoin is digital gold, Ethereum is digital rails. Institutions understand platforms. 2. Blockchain infrastructure companies. This includes exchanges, custodians, and data providers. Institutions often invest in the picks and shovels, not just the commodity. 3. Tokenized assets and real-world assets, RWA. Wall Street is exploring tokenized stocks, bonds, and real estate. This is where traditional finance and blockchain merge. 4. Crypto equity plays. Public companies with strong balance sheets and crypto exposure often attract institutional capital before riskier tokens. What smart money avoids is extreme volatility, unclear regulation, and low liquidity. This is why the next phase is likely structured, regulated, and gradual, not wild speculation. So, what does all this mean for the average American watching this video? It means crypto is no longer an outsider asset. It's being absorbed into the financial system, slowly, cautiously, and strategically. This doesn't guarantee prices go straight up. Markets move in cycles, but it does mean Bitcoin ETFs have changed the game. They've shifted crypto from alternative to allocatable. The biggest mistake retail investors make is chasing moves after headlines peak. The smarter approach is understanding why money is moving and how institutions think. Education beats emotion, always. If you want to stay ahead of U.S. crypto news, ETF flows, Federal Reserve impact, and smart money behavior, download to stay ahead. Like the video if this helped you understand what's really happening. Comment below, do you think ETFs will reshape crypto long term? This is the dream dollar, where money meets clarity.